Welcome to the deep dive. Today, we're plunging into an area of tax law that honestly always seems to catch people by surprise.
Yeah, it definitely does. Lots of head scratching involved sometimes.
We're talking about deductions and losses, specifically those times when expenses can be recognized and maybe more interestingly, when they can't. It's this whole world of disallowed deductions.
And it's, the kind of stuff that really gets classrooms buzzing. Less straightforward than you might think.
Absolutely. So our mission today is to cut through some of that complexity. We want to give you the key insights, what the rules actually say about things like parking tickets, or even, believe it or not, illegal payments.
Yeah, some real curveballs in there.
We want you to walk away well-informed, maybe a bit surprised, but definitely with some useful aha moments about, what you pay versus what the IRS actually lets you deduct.
It's an intricate dance, for sure.
Okay, but before we dive deeper, just a quick reminder, this deep dive is based on material from Farhat lectures. All the content, examples, explanations, it's all derived from the comprehensive accounting resources over at farhatlectures.com.
Great stuff over there.
Yeah, so whether you're an accounting student, maybe studying for the CPA exam, or you're already a professional, definitely visit the website. You'll find additional practice questions, video lectures, lots of detailed support to really nail down today's topic.
Definitely worth checking out.
And a special thanks to Professor Farhat for providing this valuable material. Okay, let's get into it.
Let's do it.
Before we hit the really, let's say, counterintuitive stuff about disallowed deductions, maybe we should quickly touch on the basics, how expenses are generally recognized, especially for individuals.
Good idea. Yeah, let's lay that groundwork. So, for this discussion, and generally how it works for individual income tax, we mostly focus on the cash basis.
Cash basis, right?
And what that means, basically, is you deduct expenses in the year you actually pay them. Simple as that, mostly.
So you write the check, make the payment online.
Exactly. That's generally when it counts for deduction purposes.
Yeah.
Pretty straightforward for most things.
Okay.
Now, obviously, for those maybe with a business background listening, businesses often use the accrual basis, recognizing expenses when incurred. And, of course, there are non-cash things like depreciation.
Right, wear and tear on assets.
Precisely. But that's a whole different topic, really, covered elsewhere. For today, thinking about these disallowed cash deductions, we're firmly in that when you pay it camp.
Got it. Okay, so now, here's where it starts getting really interesting, right? Let's talk about those expenses that, seem like they should be deductible, but maybe aren't. Or the ones with weird twists.
Yeah, the exceptions and the wait, what moments.
Exactly. And the first one you mentioned always gets a reaction. Illegal payments.
Right. Illegal payments. The tax law is pretty clear on this one. Generally, they are not deductible.
So we're talking bribes, kickbacks.
It's exactly. Bribes to officials, kickbacks to politicians, paying off a police officer, that sort of thing. The reasoning is pretty fundamental tax law stuff. They're just not considered ordinary and necessary expenses for a legitimate business.
You can't deduct the cost of breaking the law, basically.
Pretty much, yeah. The IRS isn't going to subsidize illegal acts through tax deductions.
Seems logical, right?
It does.
Yeah.
But then you hit this almost paradoxical question. What about the operating expenses of an illegal business?
Ah, yes. The classic counterintuitive point.
Right. Like, say you're running an unlicensed gambling operation or you're a bookie. Can you deduct the costs of that? Paying winners, renting space, maybe?
It feels wrong, doesn't it? Like the tax code is saying, okay, we'll tax your illegal income, but sure, deduct your costs.
Exactly. It feels incredibly weird.
It absolutely does feel weird, and it surprises a lot of people. But from a purely tax administration angle, the IRS and Congress generally do allow the deduction of ordinary and necessary operating expenses for many types of illegal businesses.
Like the bookie example or illegal poker machines. Yeah, those sorts of things. The idea, the policy reason, is that the government wants to tax the true income, the net income.
Ah, okay. So to figure out the actual profit, you need to account for the costs.
Precisely. If they didn't allow those deductions, the reported income might be way too high. Or maybe it would just encourage even more hiding of income because there's no way to offset legitimate costs of, the illegitimate operation.
So payouts to winners, salaries for people working in the operation, those can often be deducted.
Often, yes, for those general illegal businesses.
Okay, but then there's a big exception, right? A specific carve-out within this already strange area.
There is a very specific one. Drug dealers.
Ah.
They're treated differently. While other illegal businesses, like our bookie, can generally deduct their operating expenses, rent, salaries, utilities, whatever drug dealers are specifically disallowed from doing that.
So no deduction for transportation, paying lookouts, storage, none of that.
Nope. None of those typical operating costs are deductible for them. There is, however, one crucial thing they can deduct, which their cost of goods sold, TOG/GS. So the actual cost of acquiring the drugs they sell, that initial product cost is deductible.
Wow. So they can deduct the cost of the product itself, but absolutely none of the other costs involved in selling it.
Exactly. It's a really stark contrast. It's a specific punitive measure from Congress. It seems less about just calculating net income accurately and more about denying almost any tax benefit to that specific activity beyond the unavoidable cost of the product.
The tax code's sending a very strong message there.
A very strong signal, yes.
Okay. Moving on slightly. Another common one people ask about, especially maybe around election time, political contributions, donating to a campaign, a PAC.
Easy one. No deduction.
Flat out no.
Flat out no. Political contributions are non-deductible. The thinking behind it is pretty straightforward, really.
To stop wealthy donors getting too much influence via tax breaks.
That's the common rationale, yeah. To prevent the tax system from essentially subsidizing political influence or making it cheaper for higher income folks to influence politics. Keeps the tax code, in theory, out of directly funding campaigns.
Makes sense. Okay, so bringing this down to maybe more everyday situations.
Yeah.
What about legal fees or fines? We all get traffic tickets sometimes, might need a lawyer. Are those costs ever deductible?
Great question. Very practical and, yeah, cause a lot of confusion.
Because legal fees can be expensive.
They certainly can.
Yeah.
The core rule for legal fees is this. They're only deductible if they're a business expense.
Like defending your company in a lawsuit.
Exactly.
Yeah.
Or drafting business contracts, dealing with partnership disputes, that sort of thing. Or, alternatively, if they're directly related to income-producing activities.
Such as?
Managing rental property is a big one. Or dealing with investment-related issues that generate taxable income. But if the legal fees are for something purely personal, generally no deduction.
Even if it feels really important or costs a lot.
Even then, personal is personal for tax purposes.
Okay, let's use some examples from our source material because this helps clarify things. Say you get a $50 fine for running a red light commuting to work.
Mm-hmm.
Or maybe a $100 ticket for parking in a handicapped spot. We've all probably had some kind of ticket. Are those fines deductible?
No, absolutely not.
Why not, even if you were on your way to work?
Doesn't matter. Traffic fines, parking tickets, they're penalties for illegal acts. The IRS views them as punitive, not as necessary business costs. Plus, your commute itself is generally considered a personal expense, not a business one.
Right. The government isn't going to give you a tax break for speeding or parking illegally.
Got it.
Okay, so the fines are out. But what if you hire a lawyer? Say you pay an attorney $200 to fight those tickets in traffic court. Is that legal fee deductible?
Still no.
Still no. Why not? It's a legal fee.
Because the nature of the expense follows the nature of the underlying activity, since the traffic fines themselves are personal, non-deductible items.
The legal fees to fight them are also personal and non-deductible.
Exactly. You can't magically transform a personal fine into a deductible expense just by hiring a lawyer. The character flows through.
Okay, that's a key point. But then what if you pay, say, $500 to an attorney to draft a lease for an apartment you own and rent out? That feels different.
Now that one is different. Yes, that is deductible.
Why?
Because managing rental property is clearly an income-producing activity. It's a business, essentially. The legal cost of drafting that lease is an ordinary and necessary expense directly related to running that rental business and generating taxable rental income.
Okay, so that fits the rule. Business or income producing.
Precisely. That's a textbook example of a deductible legal fee related to income production.
Gotcha. And one more. What if you pay $1,000 to a lawyer to negotiate a reduction in your child support payments?
Also no deduction.
Really? Even though it affects your finances significantly?
Doesn't matter from a tax deductibility standpoint. Child support is considered a strictly personal item. The payments aren't taxable income to the person receiving them, and they're generally not deductible by the person paying them. Therefore, any costs related to it, like legal fees for negotiation or disputes, are also personal and non-deductible.
Wow, okay. So that personal versus business income producing line is really, really critical for legal fees.
Absolutely fundamental.
Okay, let's try and pull some of this together with a case study. This one comes from the source material too. Let's meet Trevor. He's a server, but he's also running a bookie operation on the side.
Okay, Trevor the moonlighting bookie, classic example.
So how does this all play out for him tax-wise? First, his income.
Right. Income first. His tip income from being a server, absolutely taxable, included in his gross income.
Standard stuff.
Standard stuff. And his gambling income from the bookie operation,
Yeah.
also fully included, also taxable.
Even though it's illegal income.
Yep. The IRS wants its cut of all income, legal or illegal. Failing to report it is tax evasion, which is a whole separate crime on top of the illegal bookmaking.
Okay, so all income is on the table. Now the deductions. What about his bookie expenses?
Now we apply those rules you just talked about. Remember the general rule for illegal businesses versus the drug dealer exception.
Right. Bookies aren't drug dealers, so the general rule applies.
Correct. So his gambling expenses, meaning the payouts he makes to winners, those are deductible. They're considered ordinary operating expenses of his bookie business.
Okay.
Same goes for, say, compensation he pays to someone helping him run the books or take bets. That's also a deductible operating expense. It reduces his taxable gambling income.
So he calculates his net profit from the bookie business just like a legal business would for tax purposes.
Pretty much, yes. He nets the operating costs against the gambling revenue. However,
It's always a however.
always, if Trevor, say, paid a bribe to a police officer to avoid getting shut down.
Back to illegal payment.
Exactly. That bribe is absolutely not deductible. That falls under the specific rule we started with. Illegal payments like bribes are never ordinary and necessary business expenses.
So he can deduct the normal costs of running the illegal operation, but not the cost of committing other illegal acts like bribery to sustain it.
You nailed it. That's the distinction. And, just as a side note, from a professional standpoint, dealing with clients like Trevor, it raises ethical flags.
Yeah.
The source material often includes a sentiment like, stay away from unethical people, which is generally sound advice for any professional, like an accountant, encountering these situations.
Yeah.
You don't want to get tangled up in facilitating illegal activity, even if you're just handling the tax side according to the rules.
Good point. A practical consideration beyond just the tax rules. Okay, so we've gone through a lot. Fines, bribes, legal fees, bookies. What's the big picture here? What does this all mean for you, the listener?
I think the biggest takeaway, really, is that tax law isn't always intuitive or what you'd call common sense.
Yeah, it definitely seems that way.
What seems perfectly logical, like deducting a fine you got while driving for work purposes, might be disallowed. And what seems completely wrong, like deducting expenses for an illegal business, might actually be allowed with those very specific, critical exceptions, like for drug dealers.
So you really have to know the specific rules.
You absolutely do. Understanding those nuances is crucial, especially that line between illegal payments, like bribes, which are never okay, versus the operating expenses of an illegal business, which often are, except for drug dealers. And of course, that fundamental personal versus business or income-producing distinction for things like legal fees.
And knowing this stuff is valuable, right? Whether you're studying for the CPA exam.
Huge for the CPA exam, yes. These are classic testable areas because they're tricky.
Or just for general financial literacy, understanding your own taxes.
Absolutely. It can save you headaches, prevent mistakes on your return, and just help you make more informed financial decisions overall. Knowing what the rules actually are is powerful.
Definitely. So as we wrap up, maybe a final thought to leave folks with. It's interesting to consider why the tax code has these seemingly contradictory rules, isn't it?
It really is.
Like allowing some illegal business deductions but not others, or drawing these sharp lines on personal versus business. It suggests there are broader goals at play, maybe societal or economic objectives, baked right into the tax law, even if they seem confusing at first glance.
Yeah, it makes you think about the policy behind the provisions, not just the mechanics.
Mm-hmm.
It's rarely just about collecting revenue. It's often about encouraging or discouraging certain behaviors, too.
Food for thought, for sure. Well, thank you for joining us on this deep dive into the sometimes perplexing world of disallowed deductions.
Always fascinating stuff.
And remember, if you want to explore this more deeply, check out the comprehensive resources available at farhatlectures.com. Thanks for listening, and we'll catch you on the next deep dive.